What if your investment could potentially double or even quadruple over the next decade with either MGK or QQQ? Today we dive into two titans of the ETF world, MGK and QQQ. Exchange-traded funds, or ETFs, have surged in popularity, offering both accessibility and diversity in investment portfolios. Specifically, the Vanguard Mega Cap Growth Fund, known as MGK, and QQQ present intriguing options. Key to making informed decisions are factors like expense ratios and annualized returns. Understanding these factors can greatly influence your investment strategy. Let's explore how MGK and QQQ stack up against each other. Now, let's get down to the brass tacks and compare the performance of MGK and QQQ. When we zoom in on the expense ratios, we see MGK from Vanguard Mega Cap Growth Fund at a lean 0.07%, contrasting sharply with QQQ's 0.2%. This might seem minute at first glance, but over the long haul, these percentages can significantly influence the net growth of your investments. Diving deeper into their performances, the annualized return, or CAGR, presents an intriguing picture. MGK has delivered a robust 15.64%, while QQQ leads slightly with 17.85%. Translating these returns into real-world figures, an initial investment of $10,000 in MGK would grow to $39,304, whereas the same amount in QQQ would balloon to $46,960. While QQQ shows a higher return, MGK offers a more cost-efficient approach. But there's more to the story. Remember to subscribe and comment on my phone you would like me to review next while we get into the next part. Investing isn't just about the gains. It's also about managing risk. Let's analyze. When we look at the Vanguard Mega Cap Growth Fund, or MGK, and QQQ, an interesting aspect to consider is their volatility, reflected in their standard deviation. MGK shows a standard deviation of 18.36%, illustrating the level of fluctuation in its returns. QQQ is slightly more volatile, with a standard deviation of 18.95%. This gives us a hint. Higher volatility can mean higher rewards, but also increased risks. Diving deeper, let's compare their performance extremes. MGK had its best year at 51.67% growth, and its worst at a decline of 33.59%. In comparison, QQQ's best was 54.85%, but its worst nearly mirrored MGK's at minus 32.58%. Now, considering the maximum drawdown, Sharpe Ratio, and Sortino Ratio, these metrics help us understand the risk-adjusted returns. MGK's maximum drawdown was minus 33.59%, with a Sharpe Ratio of 0.80 and a Sortino Ratio of 1.31. QQQ, while similar, edges out with a slightly better Sharpe Ratio of 0.89 and a Sortino Ratio of 1.47. Both ETFs show similar volatility, but QQQ edges out slightly in risk-adjusted performance metrics. How do MGK and QQQ fit into a diversified investment portfolio? When considering growth-focused investments, understanding the strategic fit of each fund is crucial. The Vanguard Mega Cap Growth Fund, or MGK, offers a compelling choice for investors seeking growth through large-cap stocks. Its low expense ratio and solid performance metrics make it an attractive component for a balanced portfolio. On the other hand, QQQ, with its slightly higher risk profile, might better suit those with a more aggressive investment stance. This ETF exposes investors to the top technology and innovation-driven companies, potentially offering higher rewards at the cost of greater volatility. Both MGK and QQQ show strong benchmark correlations at 0.94 and 0.92 respectively, suggesting that they closely follow their market indices. This aspect is vital for investors who prefer ETFs that reliably track the performance of a specific sector or the broader market. Choosing between MGK and QQQ could depend on your existing portfolio composition and risk tolerance. We've dissected a lot today. Let's boil it down to the essentials. MGK, with its lower expense ratio of 0.07%, offers a compelling value, especially with an annualized return of 15.64%. In contrast, QQQ, though slightly costlier with a 0.2% expense ratio, boasts a higher return at 17.85%. It also has very similar drawdowns. Remember, if you're looking for cheaper alternatives to QQQ, VGT and FTC have expense ratios ranging from 0.1% to 0.08% similar returns. Then, if you're looking for cheaper options to MGK while still keeping better returns, you could look into FSPGX with an expense ratio of 0.035% or SCHG at 0.04%. Considering these aspects carefully, or consulting with a financial advisor, could guide you towards an informed decision. Whether you lean towards the efficiency of MGK or the slightly higher performance potential of QQQ, your choice should mirror your financial vision. Happy investing! Remember to subscribe.